All right, welcome. Good morning, good afternoon, good evening. It is exactly 4:30 p.m. Eastern Standard Time. And wait for it. There it is. Not as fizzy as I would think. After a long day so far, we're going to have a little Red Bull. Whoa, that ought to be good for a good nighttime sleep. Hello, everybody. Welcome. We're going to get right into it. Tastes like Sprite with a little bit of bitterness to it. It is our monthly PUG meeting. What are PUG meetings? Persons, user group, anything that we have to do with my indicators on the several platforms. We generally give a discussion. We allow all our members to send in email requests for covering certain topics. I have two that were at the top of the list. One, which we actually went over this week, so I'll do it again. It's for seasonality and thinkorswim, so we could just get that. And then the other one is, what is my open close indicator? So I can kind of go over the open close. It's not quite an open close indicator, but it's my open close if you look at the way markets act and behave. In fact, today I made a post in late afternoon in the trading room about where the S&Ps are relative to their open and resistance levels. And if anyone has, those will be today's topics, because those were the main emails that we had gotten for questions that were specific to what people wanted to cover. If you have something you want me to cover besides these 2 points, type it in the trading room, and we'll just get right through and ease of making sure everyone has at least good insights in what we're discussing, and give a chance for everyone to get something on their mind that we can cover. So in the meantime, this trading involves risk of loss, so I'm sure everyone's well aware of that. So with that stated, let's get into the first question, which on seasonality. In fact, the question is, can't make this up. You often mention that paying attention to seasonality in trading can give you an edge in trading. So could you show me, how do you set up a seasonality indicator on a chart like, for example, LABU in thinkorswim? What time frame do you normally use? All right. So ironically, we already have LABU up. So this is like a hands down. I didn't make this up. This is a layup. One of our members wanted to know, maybe they missed the morning session or aren't able, due to work restrictions, come into the live trading room, or because there's so many different recordings, can't find what we've covered, and that's not a problem. This is a real simple deal through thinkorswim. What you see on your chart here is a 15-minute chart on LABU. What is LABU? It is the leveraged ETF on biotech stocks. Underneath that is the on-balance volume, and underneath that is the PMC relative strength indicator. So I'm going to just change this to a daily chart just to humor ourselves. And when we do that, notice that the pivots just changed color. And the reason they just changed color is that these are monthly. I believe that changed to a monthly pivot. The daily pivot are now hidden, by the way, which are pink, fuchsia colored. So if you have a intraday chart less than daily 60-minute, so for example, 60-minute, the daily pivots show up with more time. And then again, you can clearly see the blue line. If you're not quite sure what the time frame is of the lines on the chart, look straight up here and you can see it says persons pivots monthly. You can see persons pivots daily. And in the live trading room, just to disclose what you're looking at, I'm not looking at the relative perspective on a relative basis of what the support and resistance are, as much as I'm looking at the outlook of pivots, because typically when a market is truly bullish or has a bullish bias, the daily pivot, this is something we cover in in my DNA structure, the market, the pivot, the fuchsia can act sometimes as a bullish support, and in extremely bearish time frames, the pivot, the fuchsia, acts actually as a resistance more times than not. All right. So I just wanted to explain what is on your chart, and now we move forward. What you want to look at in setting up a chart for seasonality using thinkorswim is go up and first start off with a daily chart. You can also go weekly, but we're going to go daily chart here. Go to style, go to chart mode, go to seasonality. It's that simple. Go up to the cogwheel, excuse me, it's not quite as simple. Then go up to your time frame, get time frame, and you see it says 20 years. Sometimes it only has like maybe defaults to, you might be looking at a 5-year or a 3-year. Well, that's not going to give you a whole lot of history. And then sometimes some ETFs or stocks might be relatively new, like let's say Lucid Motors, which was up today. Not a lot of seasonality there. The only real seasonality that you have in electronic vehicles more than maybe 2 or 3 years would be, well, in this case, Tesla, right? But for a market that consistently you're trying to find, is there any seasonality in a normal given year? And I think right now we can all write off that this year and last year were normal given years. Defined by, what is a normal given year? Well, when interest rates are normalized, when there's not insane amounts of spending by the federal government for pandemic relief on a global scale, different policies with the new president comes in, an old president out, new president in, you get different policy changes. Sometimes you get moderate changes, like when we went from Ron Reagan to Bill Clinton. Those are moderate changes, weren't drastic over the immediate near term. But when you go from what we've just had from student body right to student body left, we get different changes in policies. Right now, we have a major push. Obviously, the big money push is in electronic vehicles, just to throw that out there. Today, we had huge moves in a bunch of names. One particular, Lucid Technologies, which I'm joking around, by the way, and I have to say this out loud. The understatement of the week was yesterday in the live trading room, we had a trade recommendation for Lucid Technologies to do the 4550 November 19th expiration bull call spreads. It kind of went a little intrinsic there because the stock was up just slightly more than 20% today. So nice trade, though. Can't complain, knock on wood. Made money. It's all good. But it certainly is interesting times. Certain things, the point being is there's certain things you can't run a seasonality chart on. And in certain time frames, not to give a class on seasonality, but one of my biggest, I would have to say, one of my biggest things of how to use seasonality is if a stock or a product, an ETF or a sector or commodity, how do you know it's been respecting its current or recent history of seasonality? And this is this is very important to use seasonality. Despite the fact that we're all pretty much all new to trading in a pandemic environment. I mean, none of us, you can't find a single soul that can say, hey, I've been in this kind of environment and I've got experience here. I don't think anyone has this kind of experience trading this kind of market right now. So as we're all sitting here together, I would find it interesting, or at least as a disclosure, or at least a fair warning or a friendly reminder that if a stock or a product isn't in sync with its past recent history of seasonality trends, I don't know if I respect that it will continue to go into a seasonal trend. And if you're not sure what a seasonal trend is, that's what was probably a good subject matter for us to go over. I like to use seasonality and look at 20 years at the very least. I think you can customize this and you can even go up to 2021. You can change this. I thought we could have done this. Let's go to like 1995 and see what happens. I don't know if it'll allow me to do that, but we're going to certainly try. I don't remember on a daily basis. I think weekly, I think we can. And then we'll go back to the chart time frame. Let me go back and look at weekly. And now we're going to go to the cogwheel, the wheel of settings, right? And then we're going to go to appearances. And you can see you have a couple choices. This says display average. One of the things that Thinkorswim allows us to do is look at two unique perspectives, yearly and average. What is the difference? Well, let's click yearly and average. Basically, what this says is that it's going to break down how many years, the different years, and give you the seasonality of the average of those trends. And so you can hit apply OK. Now, we just tried to do the seasonal trend on this, and as you can tell, it didn't give me the history. So we're going to go back to I think it's it won't allow me to do that. So go 2001 and 2021, and then go 20 years. Hit OK. And Labu as an ETF probably hasn't been around that many years, so bad choice there. If we go and change Labu, at least for the 5 years that it's giving us the backdated test studies, if you want to use the ETF that it uses, and that requires a little bit of education or knowledge. Labu is a leveraged ETF. I'll teach you how to look at history to see what you're looking at. And break this up. First and foremost, go to style, go to setting, go to chart mode standard, and then go to a weekly chart. Actually, I'm going to change that time frame. And let's go to month, and let's go to max available. Hit OK. Actually, this is IBB. So you know that IBB has, well, at least 20 years, right? If we want to find out what the history, LABU, when did it start trading? As you can see, this one was late 15. So you can't do a 20-year backtest study or a 20-year history on seasonality because the ETF has only been around since May of 2015. So that's first and foremost, don't rely on the computer, double check the work. So if you're not familiar with how long a product's been trading, go to the highest time frame you possibly can. You could probably go quarter, but in this case I use monthly, and go back and say, well, okay, how much data does this computer or this software allowing me to look at? For looking at seasonality of Labu, what is Labu again? It's a biotech ETF. So are you looking at seasonality on the leveraged ETF, or should we be looking at seasonality on what the leveraged ETF is doing based off the underlying ETF? And it's the latter. You should be looking at the underlying ETF first and foremost. So if you follow me there, that's the first lesson that we would look at. So if you're looking for seasonality, it's not Labu that you're looking for, it's biotech sector. So the IBB has been around a little bit longer than the XBI, and it has a higher weight. So I always look at the IBB, the biotech sector ETF. And for that, now that you have your chart up, you go, okay, I got good 20-year history. I'm going to change this back. Let's go to the day. Let's go to style. Let's look at seasonality. And you see all this spaghetti noodles. And you go, what in the heck is this? Well, first off, the bright blue is the price chart. And that's why it's at the top end of the chart. This would be your bright blue is your actual chart. Everything down below, the spaghetti noodles, are all the individual years. Now, if you can see and differentiate between that white and that off-white color, up here, it lists every color. So you could separate. Look what happened in 2005, 2006. You could see all the years up here if you wanted to look at individual seasonality. If we go back over to the cogwheel of settings, and you go back to appearance, this is what we have here is the average of all of these years is this bright, thick orange line right here. It takes the average of all the years' trends and then gives you one line. So you can kind of look at this and say, well, what year was a bad year? What year was a good year? But on average, what is the seasonal trend for this time of year? That's the first thing that you want to differentiate. So I'm going to change this back to the average, and we're going to hit apply and OK. So we're looking at the average of the last 20 years. What is the general trend this time of year going into the end of the year? on or about, on average, October 25th marks the end, or at least it has an upside run in the market. Generally speaking, we see biotechs with an upside move in the market. To be honest with you, has the market behaved bullishly, or have we seen the market behave in sync with its seasonal trend? So what I want to do is I just changed it to a daily chart. And I'd say, well, it generally peaks out and it has a downtrend. And we look at this year and we go, well, all right. So recent history shows that it's kind of from time to time, it's been in a little downtrend. And then from on or about November 13th until on or about the December 30th, this is when we start to see an uptrend. So right now, we don't have that uptrend moving yet because now the price is in a downtrend. But this seasonality is on an average. So you can't say this is the hour of the second that I got to be buying. It just says that sometime in this period, you want to look for, on average, we have had trend runs. Now, you get a lot of choppiness in here, as you can see. But on average, in the last 20 years, buying on or about the 1st of November, holding into the end of December, biotech has had a liftoff. So do you want to look in this this tool and say, I'm going to guarantee profits every time I do this? You would be, that's wrong. That's not true. That can't happen. It's just a guide. And most importantly, if you say, well, is the market even respecting its seasonal trend this year? I mean, recent history says, well, in August, September, it generally goes down. We just discovered it has. So there might be reasonable argument to say, hey, it's been respecting its seasonality to a degree. Maybe it will therefore continue to respect its seasonality. That's how you can, I mean, really top, bottom, hopefully this is clear and concise. If you're looking for a seasonal trend, look at a product that's been around more than a couple of years. If you're looking at a seasonal trend, don't look at the leveraged ETF. Look at what the leveraged ETF is traded off of. Look at the underlying ETF. And so if you know that maybe perhaps a stock like Biogen or Amgen or Regeneron, those names might have influence, you can look at, let's see, I'm looking for Regeneron. Isn't that Regeneron? Yeah, Regeneron, R-E-G-N. So if you take a look at Regeneron, you go, well, wow, this is this year's movement. Does it respect seasonality? And you could say, well, it's arguing that in this time period from on or about August till about the whole month, it generally goes down. In this case, it went up. So the blue line represents the current year. The orange line represents the history of the average. And so never assume that your settings are correct. This, look at that time interval. It only went back 10 years. We just had it on another commodity or the other product, which had 20 years. So I want everyone just to see, you saw that. I didn't change anything behind the scenes. Otherwise, the pop-up box, I'm not sure why that happens, but always double check your work. Never assume that it's automatically correct. In other words, make sure your settings, if you're looking for 20 years, make sure you start from A to Z, the top to the bottom. Here's my commodity. Here's my stock. Here's the ETF. I'm looking for 20 years. Okay, fine. Does it have 20-year history? Go to a monthly chart on the underlying. Look at the monthly chart and see if there's 20 years. You may be surprised and say, there's not 20 years. If you're looking at gold futures, we got 20 years. If you're looking at the gold ETF, we don't have 20 years on GLD yet. GLD came out, I believe, in 2005. It's got 16 years of seasonality, but if you're asking for 20 or max available, quite frankly, you're not going to get on certain ETFs. They don't have a huge history. As a general guideline, the longest running, oldest ETFs started with, I believe it's the S&P, the NASDAQ, and then I think they came out with the diamonds. The oldest one, I believe, is the S&Ps. So as far as ETFs are concerned, quite frankly, it was the S&P 500, the SPDR ETF that came out, and then the NASDAQ came out. Those were the oldest ETFs. Then the second wave was gold and silver SLV, then and then all of a sudden after the crash of the real estate crisis, the financial crisis, we had every other ETF in inverse ETFs were created. If you remember, there was a time period, I think it was 2014, 2015, 16. We had something like 7,000 ETFs. They were obscured. And then we have global market ETFs, the EEM, the list goes on and on and on. Always make sure that whatever you're looking for seasonality has the history. And then, secondly, make sure the settings, for whatever reason, change on you. You can use weekly. It doesn't really matter whether you're using daily or weekly. You're looking for the general trend of the market on seasonality. So if you look at over 20 years of seasonality on Regeneron, it actually doesn't do much in a seasonal trend in this time of period. And you'll find out in the last 20 years, the actual bottom is in February for Regeneron. Why did I use Regeneron? I just happen to know that certain stocks have more influence on that market, such as the FANG stocks, Apple, Facebook, Google, Tesla, FANG, FART, call it whatever you want, have more FART, F-A-R-T. That would be, let's see, Facebook, which has now changed their names, but it was Facebook, it was Amazon, Roku, and Tesla, F-A-R-T. So you got your FART and you got your FANGs. So either way, the high-tech names of the 5 stocks have maybe 30% or 33% influence on the price direction of the Qs, by the way. So if you're looking at a couple stocks and you're looking at the Qs, in recent history, those names have overpowered the performance and the seasonality. So it has changed, and you just have to use it. It's not as cut and dry as it once used to be. It's not as simple as it used to be because, as we all know, things have changed. So if you're looking for, at the very least, if you're looking to do a seasonal study on any product, make sure it does have the history, make sure it has been trading, make sure your settings are reflecting what you're asking the computer to extrapolate for you. I want this data extrapolated. If you're asking and you think you wanted 20 years and you think that the computer is set at 20 years, double check by going up to the time period, time frame, and see what it says. Sometimes it may be defaulted to like 2 years, and you go, and if you're not diligent about it, you may find out, oh, look, guaranteed we go down. Well, in the last 2 years, maybe it went down, but over the life of history, it didn't. So that's hopefully that answered that particular question thoroughly, and then also gave people an insight as to when can seasonality help us. We've had a few commodities here, by the way, and if we go and we look at, and if I'm not mistaken, I believe it should be ZW, right? For electronic wheat. Yes. So wheat futures, Thinkorswim didn't trade commodities or list commodities for a long time. Let's take a look at the seasonality on wheat or corn or any of the grain complexes. And as you can see, this year is expressly unique. The reason I bring this to your attention is because this might not have the seasonality. Let's double check. I haven't used the seasonality in the commodities. So this would be a great example to say, what are we looking at? 20 years, weekly. Okay. Go to the setting wheel, go to appearance. Let's break it down and go yearly and average, apply. Okay. And then we know that with all that spaghetti noodles, we know that every year there's our commodities that list what years have gone up and what years not gone up, right? So if you go back and to the setting and you say, all right, appearance, and I'm just going to put the average. As you can see, is wheat prices typically it bottoms out in June, has a good little run. Okay, it bottomed out almost to the day, had an upside, went down, did one of those little sneak attacks, what we call an Arthur Merrill W11, slammed everybody on stops that were probably long, got them out, and then just skyrocketed, and the seasonality trend did work. So it was maybe a week or 2 weeks late, and it lasted 2 weeks or a week later. So you could take a look at this and say, hey, sometimes the market's right within that seasonal trend. You know that if it's a time period, I guess from lower left to upper right, this is a seasonal trend of the market. You'd say, yeah, there's some rough patches along the way, but typically speaking, in this time frame from June, or from this time frame that you've got in November, you see end of year run-ups, and you're seeing wheat prices, escalate. So in a hyperbolic bullish environment, can the seasonality trend be magnified? And that, I think, is something to take under consideration. We are absolutely in a whole different category than any other year over the last 20 years. So if there's more demand, there's less supply, and there's more money than ever, and people want to buy things, then guess what? The seasonal trend could be exasperated. We could see that acceleration in prices. So I think what we need to also understand about seasonality is that the first thing is it's never a guarantee it works. It gives you the average of on average what the maybe there's a better time of the year to be long. Maybe there's a reason why people buy gold, or manufacturers or jewelers buy gold at certain times of the year to prepare for an onslaught of retail demand. Maybe there's a reason that pharmaceutical stocks go up certain time of the year and other times they don't. On average, if there's nothing else to trade off of, then this might be what you pay closer attention to. In the environment that we're in right now, and obviously, let's face it, we've got a different political party with different agendas that are happening, a push towards cleaner energy. So everything that we get into clean energy right now is off the charts to a degree. We have another a segment of the market that might be dipping into the metals arena with inflation hedge, and that might be the fact that there's this thing called cryptocurrencies that people are buying into. And so therefore, is seasonality working in all areas this year? And I have to say, absolutely not. But as a guide, I don't like to sell short something after it's already declined when it's coming into a seasonally strong period of time. There's a reason why there's seasonal strengths and weaknesses in the marketplace. And when you do look at seasonality, what I've always taught at all my seminars is that when you look at seasonal analysis, technical analysis trumps, no pun intended, but supersedes seasonal analysis, because the years it doesn't work, pay closer attention to your technical work. What is your technical work? Your location of price to pivot points. Are we in a higher time frame monthly pivot bearish environment? Is the volume on the rallies shriveling up? Are we in negative divergences with price? Is there no volume in the trade whatsoever? We might have the greatest ideas of life, but if nobody wants to buy it and everyone wants to buy Tesla or Lucid Technologies or anything else under the sun, they don't want to buy what should be going up. That's what causes value changes, right? So we're kind of in that environment. I think I mentioned that earlier today in a live trading room. It's more of a visceral market environment. People are trading off the headline news, and moves are getting, we're just seeing unbelievable moves up and down, by the way. So remember, in certain stocks, we don't have consistent seasonality. It's impossible, by the way, to give me a seasonality on this company called Peloton. It's impossible. Why? It hasn't been around that long. So it's got maybe a 1.5, 2 year, something like that. So if you're looking at a stock and you're looking for the seasonality, you have to understand that it's better for the overall ETF than it is maybe on short duration stocks. So just keep, a short duration meaning a stock that's relatively new and doesn't have a lot of history. That makes sense, right? If you take a look at the SPY, the S&P 500, and that's what a lot of people are talking about, seasonality. So from on or about the end of September, we see seasonality strength, and everyone's like, well, I don't want to really fade this market because seasonal, it dictates that the market goes up this time of year. You know, the other argument is, well, seasonality dictates the market goes up all the time. I mean, bottom line, from March, if we take a gander and go to time frame here, we are 20 years. It is a weekly. So this represents, this little chart here represents the S&P over the last 20 years. It just typically, and that's, you know, every once in a while you get little sell-offs. By the way, if you want to say, hey, from November 8th until November 15th, you get sell-offs. From the 15th, the market sometimes rises going into Thanksgiving. And then after Thanksgiving, you get an after Thanksgiving decline. And so if you're looking at that, then what you would probably say, well, how valid would that information be? And the obvious answer is to understand, well, what has the market been doing? Has it been respecting its seasonality? And you'd say, I don't know, but it just doesn't have the feeling of respecting seasonality in this marketplace. So the stock market this year has kind of been out of sync with the typical, because why? The infusion of, let's face it, near zero interest rates, et cetera, et cetera. You guys know the story. I don't need to rehash the story. And that's the, I hope that answers the question. How do you go back? Go to style, go to your chart mode, and go back to standard, and everything should be voila, easy peasy, right back. Now you hopefully remember what the chart was. And if you don't, when you close your Thinkorswim platform out, right click, restore cells. If you close out your platform, it'll say save configuration, go no, and it'll put back your configuration or whatever your windows or your settings were that you originally wanted. And that's your, you know, how you can use your seasonality on tool on Thinkorswim and what's important when looking at seasonality. It's not just a guarantee. Don't look just at any stock. Make sure there's history. What are you looking for seasonality? What does the term mean? Over history, during the years, on average, there's been a seasonal tendency for the market to go up, down this time period of year. If there is no history, then the seasonal tool is not efficient in that regard. If you're looking at a leveraged ETF, there might not be any history on the leveraged ETF, but what the leveraged ETF represents, there might be plenty of history on the underlying securities. So know what just do a little bit more due diligence in thinking through what you're asking and the information you want. All right. Hopefully that was resonated and found it finds the individual with the right answers. Okay. What is my open close relationship? Earlier today, I even said there was an interesting setup, and I will just simply say, on average, what constitutes a trend in the market, or a bull market, or a bear market, and when do we see more times than not, if a market opens after the first, I call it 20% rule, after the first 20% of a time frame, if the market opens and trades below the open, the odds are you might find the higher the low end. And for looking at a daily chart, or we'll go to a weekly chart here, one of the observations that I had posted in the room, it's fairly interesting. We've been teetering against a high in the market for the last 2.5 weeks. This would be 1 week. This is 2 weeks. This is 3 weeks. And you know, what's interesting, the little hash mark on this line represents the current week's open. And what I posted in the room was real simple. If a market opens unchanged or a little higher, or trades higher, and then within a day or two, you get a market that closes, or even midweek, a close less than the weekly open. I mean, after all, when you get a bull market or at least if the market's bullish, it might open higher, open a little lower, but it'll open. And then it wants to fish around, and then the market at some point has a little bit of testing and makes a low. And at some point, it comes back to the open and closes greater than the open. So that gives you the supposition at the very least, if 20% of the time has gone by and the market has established a small range, traded below an open and closes back above the open, the odds are about 67% probability the low for that session might be in. and you can expect at the very least maybe some follow-through upside. Inversely, if the market opens and it has, we don't have a really big range relative to historic weekly ranges here. If the market, just by coincidence, if it happens to have opened, traded higher, and has a daily close back underneath the open after, say, the first 20% or greater time frame, the odds are you could see the market reverse lower. Now, as you get in on a weekly chart, as you get closer to the end of the week, markets that tend to close below that open tend to have maybe more follow through to the downside in normal years without pandemics. But I found it intriguing this week right now that we've heard the old phrase, buy the rumor, sell the fact. And the rumor was that we were going to get an infrastructure bill, and the markets run up on not only more stimulus, but maybe the Fed's going to stand pat, blah, blah, blah. Everyone's got money. There's more money pouring into the market, and everyone's going to do fine, and stocks are going up forever. But I think what we need to be aware of is that party and that line of thinking at one point is going to end one day. And I don't know where it is, but I know the conditions. If the market is truly bullish, and if we've had bullish events, how do we not know that the market's overstretched? How do we not know the market already priced that in? What is a good gauge to say, hey, I want to be aware that something could go wrong? Is if the market closes after the first 20% of the time the market open on a weekly basis. That's Monday. So by Tuesday or Wednesday, if the market closes below the weekly open, we could have a supposition that the market did open, it traded higher, and if it comes back and closes below the low, it could spark a downside momentum move. That's the open-close relationship. So I thought I'd share this with you in current times. It's kind of an interesting observation. Will it come to pass? Well, it didn't today. We were within a dollar of the weekly open. But I did find it interesting that with all the spectacular news in the market, we couldn't find the strength to power higher yet to make another new high on the year. So I'm sure we will, pretty sure. I mean, volumes, it's so close. I mean, it would be amazing if we didn't, right? I mean, but I think we also have to be under the guise of, hey, how much is priced into the market? I don't have that idea. I don't have that answer. I do know that when everyone's bullish and everyone's in the market, I mean, who's left to buy? And that's the whole term of being overbought. I'm not going to pick a top. I'm just going to be wary of what causes markets to start to roll over. And what starts markets to roll over is when they close below their weekly open. Markets that gap up, they trade higher, and they close below the open, it doesn't give a sense of extreme bullishness for that time period. And it opens the door for more downside potential movements. So a market that may open lower, like in this case, open lower, trade lower, close back above the daily opening range, odds are your 67% probability is the low for that week was in. So that's the open-close relationship, and I would say that that's how we can look at whether it's a daily chart or, in fact, a monthly basis. And that's a specific John Person observation. It's not something I copied. I learned this the hard way. This is a true, I would have to say we were working on an indicator for our TradeStation package. It was hard to do based on the different time frames. We couldn't lock it down and be universal for the day, the week, the month. So therefore, it kind of got scrapped on the background. But I use this visually and have for probably 30 some odd years. So I find it to be fairly efficient and effective. And I think that knowing the market environment we're in and knowing the current events, and one of the biggest current event is we just signed a big package, more structural stimulus over time in the market. Maybe there's another one that the market thinks it could happen. I'm not sure. Or maybe there's more earnings that this week. We'll see what happens with NVIDIA. We'll see what happens with other names like Macy's and where consumers are. Those particular names aren't what I would say heavy cap weighted effects on the index. And again, at one point, you know, the only thing that could really derail a stock market bubble or bull would be the Federal Reserve. And as they always do say, the other phrase is, besides buy the rumor, sell the fact. I mean, everyone's heard that phrase. The other phrase is don't fight the Fed. And if the Fed, for whatever reason, wants to keep interest rates at zero, you know, for another year, I don't know where the overall equity market will go. But I will tell you, there is an incredible gyration of stocks and an unprecedented amount of stocks that are unwinding off their highs. I'm pretty sure many of you are aware of it, whether it's Peloton, whether it's Sam Adams, whether it's, I don't know, Disney, whether it was Walmart today, WMT. I mean, the list goes on and on about what's running this market up. It's not energy. It's not financials. We take a look at the XLF, which is a broad-based ETF. You know, relative to the S&P 500, it's up. This tool is the relative strength PMC. When we take a look at the financial ETF, this encompasses the CME, a commodity exchange. It encompasses big banks, investment banks, big banks like a Wells Fargo, a Citi, a Bank of America, Goldman Sachs, and I believe a few insurance companies like Prudential, Metropolitan. And so therefore we have a sample of financials in this ETF. But this ETF, as you can see, the financials has not a relative strength to the overall market, has not participated in the rally. So if you're looking at seasonality, you also want to pay attention to the relative strength performance of the market. Because if seasonality dictates the market should go up and the relative strength is weak, I mean, that's one technical tool. So when I tell you technicals supersede or trump or supersede seasonality, these are the two of the tools when it regards to trading stock and equity sector ETFs that you would want to take a look at. If you want to nail it down, you can take a look at the regional bank ETF, the KRE. You can take a look at the insurance company ETF, the KIE. And you can break down those individual specific sectors or subsectors and say, gee, maybe the insurances, they're underperforming because they're red. There's no volume in the trade whatsoever as reflection of the on-balance volume indicator, and the sector's moving sideways. So right now, insurance companies are sitting out on the sidelines on this major equity market rally and not participating. The other one would be to take a look at the XLE, the energy. Ironically, the XLE looks just like the bank sector, doesn't it? Over the last, say, month and a half, it's done nothing but sideways, relative strength weak. There's good volume in it, but nobody is really aggressively buying a breakout in the energy sector. With the energy sector, XLE is the same story. It's a broader ETF, and you have two subsectors within that. One is the oil service sector, the OIH. And clearly you can see, well, this is not working out. There's two companies in there that pretty much run the roost. One's called Halliburton. There's the downside action. It reflects, I mean, if I didn't tell you I changed the symbol, you wouldn't see the difference. OIH looks like this. Schlumberger, or excuse me, Halliburton looks like this. I mean, it's hard to see a difference there. Now, we have an actual option position in Schlumberger. But Schlumberger, interestingly enough, does not look as bearish as Halliburton, interestingly enough. The relative strength, it just shows that the stock is going sideways. That's what the relative strength. The stock market's gone up. The stock's gone down. Volume, though, is not going up or down. It's sideways. It's neutral. So this is a product that could break out either way. We just have to wait to see. Hopefully it's up because we were in a 32.5, 42.5 expiration January 10 wide spread. And we bought that about a month ago, and it's just sitting there. So if you're looking at seasonality and you're looking at, and I just want to be clear, when I say technicals supersede, what technicals would I be looking at? Well, I said pivots, I said volume, and then I just want to make sure we have a better tool out there when it comes to stocks and ETFs. is to look at the relative strength tool, the PMC. That is also available, and this is HGSI. The PMC, as I pointed out on the Labu chart, is also right there, or available. It's not right there. It's on the chart that I use for most of my work. I'm looking at that relative strength tool. The only difference between this chart and this chart is that the on-balance volume is on the bottom of HGSI and the on-balance volume is in the middle quadrant of TOS, but there's still everything's set up. Pivots, PPS indicator. So whatever product it is, I actually, unlike some people, I really do use my own work. Anyway, that's a joke. So with that said, that does conclude tonight's time. The dashed blue line on the top pane, the dashed blue line, monthly pivot, JP. That was what we said in the beginning. We have, in this case, on an intraday basis, 30 minutes, you got daily combined. And if I change from 30 and I go to like a 4 hour, or excuse me, let's go to 1 hour. I think it shows up on a 1 hour. There it is. On the 1 hour, we have daily pivots with monthly pivot in this particular chart. All right. Gerald sees Tesla's prediction. Very unpredictable. You know what? I'll give you a Tesla because it's already here. What we were talking about the other day in Tesla was money was coming out of Tesla and going into Rivian. I mean, obviously, it was almost tick for tat. I mean, bottom line. This was some of the work that we were looking at with Tesla. We had, these were homemade lines. I was suggesting that besides that high, if we had a green, would have been a breakout to the upside, because at this point we only had, as you can see where the line stopped, this red line, a close below the red line, and the market, I was projecting a downward move to that first support and then that second support. As Tesla's stock shared started to decline, we came close to the first support. Bottom line, what is the condition of the market with volume? How much volume really came out yesterday? As the stock went down, there was no volume really that eroded. Now, we all know that Tesla's got some selling pressure from Elon Musk. That's the headline news. And so when we take a look at this particular trade, if it's going to break out, it looks to me like it's still in a range. But if it's going to break out, it has to be, just like I said before, if a market's truly bullish, it should be north of pivots, not south of pivots. Right now, we have a market that has been acting as it rolled over from being bullish. Daily, weekly pivots are higher, higher, high. And then it rolled over, and daily, weekly pivots were making lower, lower, low. Is this going to be in a sideways range for another breakdown? We'll find out. If or not, it can break back above that green line. If it breaks up back above that, closes back above the green line, a close based on that 1 hour chart with an uptick in the OBV, the supposition, or at least the analysis would be it is a breakout, and the market's going to want to try to test from the point of its original breakdown or old support, which seems to be reasonable right into this line in the sand. There's your Tesla. That's the information. God bless. That concludes our time tonight, our PUG meeting. And this is the kind of work that we do day in, day out in the live trading room. So I'm a little burned out at looking at Tesla again. Thank you very much, Gerald T., for the question, though. And no fault of your own. But I definitely wanted to make sure that everyone understands the market environment that we're in right now is developing post-traumatic syndrome disorder. Gerald, it's okay. It's a good question, man. I'm happy you asked the question. First off, I ask people to ask questions. I'd much rather have you ask that question and me go over it than not. So very nice. But you got to admit, this market environment, guys, ladies and gentlemen, is what was good yesterday is bad today. And then all of a sudden you get those sneak attacks where the market's up 20, 30%, like in the case of, like, say, Roblox, right? Or there's landmines out there. If there's something that gets punished, it's not down 3, 4, 5%. It gaps down 10, 20, 30%. So the market is actually rotating itself, and it's getting in. And I know the advanced decline looks good, but the market's getting the participation of names is getting fewer and fewer of newer highs at this point of where we're at. And it's kind of weird. And case in point are some of the names that you're seeing right up here, except for, the newer IPOs. And again, Lucid, which I took off, which we had earlier today. And the reason we took that off is because, the trade expired. We were in a 45-50 call spread for Lucid Motors. Anyway, I hope that answered some questions, Gerald, if that helped you. Is there seasonality with Tesla? This is now such a saturated market between Lucid, NIO, Nikolai, Ford, GM, Porsche, Mercedes, Audi. Audi's got a cool car. Everyone and their brothers and sisters are coming up. Volvo, I think, right? Volvo's got one too. Everyone's got their own make, model, and their EV, and then hybrid. And then we didn't even discuss who cares about hybrid anymore. It's really a fascinating field. With that said, it's diluted at the very least. And if you're going to buy and you're a fund manager, you don't want to get rid of all your Tesla, but you probably liquidate some of your Tesla to help maybe put money to work in some of this other space. It is the hot topic, and one of the reasons it's a hot topic, and it started in January when we had a new president who said, "Hey, we're pushing the Green Deal again," right? Isn't that what what really sparked this? Because all of a sudden now, what superseded any other sector? We had pot sector that was hot for a while, no pun intended, and it's not. It's like a school of fish. You go after a bait ball, and when they're done eating, they move on somewhere else very quickly. And that's what's going on with this market. Pretty wild. Thank you for joining me today. I think the tools are very helpful in understanding what's going on. And at the very least, absolutely. What is this comment with PayPal? One thing I've noticed in this market environment is that markets tend to have massive gaps. And then you give it some time, and then they tend to fill that gap by a gap. In other words, the odds lately have been, and you can see the gap in here starts from about, this high, extended out, that old pivot, and these lows. So this area is a gap in the chart about wide enough to drive, I would have to say, a new Tesla S model right through it, right? If the market's going to be bullish, it will more than likely gap higher and go back up. And so if it gaps higher, and again, by the first hour of the day doesn't close below the open, the odds are it's filled the gap. And it could be a little short-term island bottom. This is PayPal, by the way. I made that comment that lately, because I've been saying this all year, a lot of markets, gaps tend to get filled not by the price structure, meaning a trade, like the market opens a little higher and it goes up, it fills the gap, and then it comes right back down again. Gaps tend to have been lately been filled because they just go in and punish any investors. From 220 to the market opening at 212, $8 move, not a big deal, but just slamming people in the face, right? This market is not something that just tends to go like these little moves. When it wants to liquidate the book, it just destroys people. And it left this wide gap. So watch a couple anomalies or observations that I would say this is another John Person observation. We've seen gaps being filled by gaps this year. Watch that as you carry forward. That and the open-close relationship. Thanks for joining me today in our pug room, in our pug meeting. And we want to thank everyone that contributed for the questions. I think that it got a very good engagement from a technical perspective in keeping things a little bit more, honestly, a lot of people look at seasonality and they don't look at, first off, is there any seasonality with Labu? No, you're asking if you didn't know any better, you'd say, let me look at the seasonality on Labu. Maybe you don't know what the product is. Maybe you think it's been around 100 years. Well, it hasn't, but biotech has been around a while. So the leveraged ETF hasn't. So if you're looking at the seasonality on the underlying, you got to, at the leveraged ETF, Look at the underlying. That's the big main takeaway of today. Besides the fact, if you're looking at seasonality, double check and say, hey, what is the environment we're in? Are we in a normal year where normal seasonality will exist? Has the market been respecting all year in past recent history? Has this product respected its seasonal trend? Because if it hasn't, how can you rely that it's going to continue to then all of a sudden go into its seasonal tendency? You can't. Therefore, remember, technical analysis supersedes. Follow the path of the market. If the market truly is good, remember this: volume will generally lead the way. And that's why the tool, at the very least, a tool like on balance volume can help you give direction. Is there buyers going into the market? Are you seeing an upside in volume relative to the price? Anyway, that's my 2 cents. Thank you for listening. And just remember, this is a wild market. And, if you feel that you're missing out on something, and anyone scrambling to have to buy a stock that just rallied like Roblox, wait, I'm sure, if you missed the bulk of the move, don't walk away. Don't chase something like that, because in this environment, when they decide to rip the cord, you're going to be stuck with a product or a stock that's going to get punished on an open one day. If you don't believe me, just take a look at any other stock that we've seen in this year, whether it's Zoom, Peloton, closes, open economy stocks. Say the banks should have gone up, that airlines should have gone up. I mean, it's pretty crazy. Thank you all. Be good. Gerald, thank you again for the question. Seriously. Andy, thank you for being here. George Valle, love having you in the room. Thank you all very much. And we'll see you at the next meeting. For those and for others, we'll see you in the live trading room tomorrow morning. Thank you.